Okay, so let's start. I want to introduce this new topic, and our topic for today is called group cash flow statement. That is the topic we want to cover today. Topic is called group cash flow statement. So allow me to introduce it. Now, again, this is not a new topic to you. You must have covered cash flow when you are doing financial accounting, or financial reporting, but we are saying it's not a new topic to you at all. But before we discuss the aspects that affect the group, normally affect the group, let us remind ourselves, how are you preparing a cash flow for an individual company? How are you preparing a cash flow statement for an individual company? Because we shall still need all that information on the group aspects that we shall cover. We shall still need that information when you are doing a question on group cash flow. Okay? But for now, let's remind ourselves what you used to do. Listen. Remember, whenever you are required to prepare cash flow statement, you had to classify your cash flows. Into three categories. One is what you used to call cash flows from operating activities. That was one class of categories of the cash flows. You had to identify all your cash flows from operating activities. Once you identified them, let us assume you have identified them. Of course, some were positive, some were negative, whichever they were. But let us assume you have identified those cash flows that are from operating activities. You remember, you had to get the total or the net of all of them. Whatever you got as the net, you had to push it to the extreme. That figure we are pushing to the extreme would either be a positive amount or it could be a negative amount. If it was a positive amount, then you are calling it net cash inflow from operating activities. Net cash inflow from operating activities, if it's a positive. If it was a negative, you used to call it net cash outflow from operating activities. That was the first class of the cash flows. After you had identified the operating activity cash flows, you had to go to the second category, and that was what you used to call cash flows from investing activities. Cash flows from investing activities. Okay? That is the second class of cash flows you had to identify. Of course, let us assume again you had identified them. Some were positive, some were negatives. Whatever they were, once you identified the cash flows from investing activities, you had to get the net again for all of them. Whatever net you got, you had to push it to the extreme. That net amount, let us assume for now that you got a negative amount. Meaning your negatives were more than the positive. If it's a negative amount, you call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. That was the second categories of the cash flows. We are assuming you have identified them. We shall of course discuss them in details, but for now we are looking at an overview of how you used to prepare the cash flow. Then finally, you had to come to the last category, and that is what you used to call cash flow from financing activities. Cash flows from financing activities. Again, you remember, you had to identify them, whichever they were. You had to identify all those cash flows from financing activities. Some of them could have been positive, some of them could have been negative, whichever the case might be. Okay? Again, once you got all of them, You have to get the net of all of them and push that amount again to the extreme. Push that amount to the extreme. For now, again, we want to assume you got a positive net amount, a positive net amount. If it's a positive, you remember you used to call it net cash inflow. Net cash inflow from financing activities. Net cash inflow from financing activities. Okay, so that's how you had to identify the cash flows with the three categories: the operating, the investing, and the financing activities. And the financing activities. Listen, once you got those three figures, the operating amount, the investing amount, and the financing amount, you had to get the total of those three figures. You remember, you had to get the totals of those three figures. The total that you got, again, would either be a positive or a negative. If you got a positive amount, you remember, you used to call it increase in cash and cash equivalent. Increase in cash and cash equivalent. If it's a positive, you call it increase in cash and cash equivalent. If it was a negative, you used to call it decrease in cash and cash equivalent. Okay? Then after that, you had to come to the next item where you remember you had to add what you are calling opening cash and cash equivalent. Opening cash and cash equivalent. Whatever the closing last year, whatever was the closing cash and balance last year, that automatically became the opening balance this year. So you add that opening cash and cash equivalent. Then whatever answer you got there, that amount is what you used to call the closing cash and cash equivalent. The closing cash and cash equivalent, which must agree, listen, which must agree with the amount that you are given in the balance sheet by end of this year. That closing cash and cash equivalent must be the same as per the figure in the balance sheet end of this year. As per the figure in the balance sheet end of this year. So I've just reminded you in an overview, how you used to prepare a cash flow statement, where you had to identify the cash flows from operating activities, then you go to the investing activities, then you go to financing activities, then you had to get the totals of the three categories. Once you get the totals of the three categories, we have said if it's a positive, you call it increase in cash and cash equivalent. If it's a negative, you call it decrease in cash and cash equivalent. Then we have said you add opening cash and cash equivalent. Then you have to get the closing cash and cash equivalent. Okay? Now, before we go into the details of each section, let me talk to some new students who have just joined us. Now listen, for the new students who have joined us or who are in this group, please subscribe to my YouTube channel if you have not subscribed. You can click that subscription button as you are watching the video, and click the subscription button to subscribe to my YouTube channel. Okay? You can subscribe to my YouTube channel if you have not subscribed. 2, for those who have friends and they are doing advanced financial reporting, now I'm talking to everyone. Those who have friends and they are doing advanced financial reporting, you can tell your friends that we have online classes for advanced financial reporting, and the classes we have either early morning classes or evening classes. So if you have friends who are doing advanced financial reporting, tell them we have online classes for advanced financial reporting, either early morning or evening. Okay? We also have, or if some of you may have friends who are doing financial reporting of the intermediate level, tell them we also have online classes. We also have classes for financial accounting of the foundation level, that is the level 1, and also for financial accounting of the ATD level 1, and level 2. Level 1 and level 2 has financial accounting there for ATD, that is for level financial foundation and the one for ATD1 and ATD2. Okay, good. Now, if your friends cannot attend the live class like we are doing now, your friends cannot attend the live class, then they can still buy what we call pre-recorded videos. Pre-recorded videos, where they buy the videos for the whole syllabus. They watch them at their own free time, at their own pace. Okay, anyone who is interested, let them call me on this number 0722 65 8875. 0722 65 8875. That's my number for any one of them. So tell them we have these classes. If they want, they can join us. Okay, for those who will join the live class, we shall give them the videos of the previous classes. Let them not get worried. They'll get the videos of the previous classes. They are buying pre-recorded, they get all the videos at once. Okay, I think that's all I wanted to mention, especially for the new student who have just joined us. I was asking them to subscribe the YouTube channel by clicking that subscription button down there. Okay, then for everyone, your friends who are doing this subject or financial reporting or financial accounting, they can join us and we continue together. That is advanced financial reporting, and financial accounting of the 3 levels. Okay, so let's go back now. That's all for now. So let's continue from there. We want to continue back to our class now. Let me go back. Now, I want us to discuss again, how are you determining the cash flows from the operating activities? Now we are continuing with the subject now, with the topic. How are you determining, again, the cash flows from operating activities? But before we discuss how are you determining the cash flows from operating activities, you need to remember, when I say we are looking for cash flows from operating activities, what do we mean by operating activities? What do we mean by operating activities? Now, you remember, because I'm saying this is not the first time you are doing cash flow, but you remember, operating activities are those transactions and events, that are used in the determination of profit. Those transactions are what we classify as operating activities. All those transactions that are used in the determination of profit, that is what you call operating activities. For example, if we take this as our P&L account, let me use a T format for the P&L account. You know, we normally debit P&L account with expenses, and we normally credit P&L account with the revenues and gains. Then we normally compare the revenues on the credit side with the expenses on the debit side. Then the difference is what we normally call to be the net profit before tax. Okay, good. So what are we looking for? We are looking for the net Palicini. Down there, we said we are looking for the net cash inflow. Net cash inflow or outflow. It could be a negative, it's an outflow. If it's a positive, it's an inflow. We are looking for the net cash inflow from operating activities. Now listen. So it means in principle, listen, it means in principle that if all our revenues on the credit side and all our expenses on the debit side were by cash, listen, were by cash, then in principle you could say, therefore, that the net profit before tax represents, the net cash inflow. I have said, if everything in the income statement was by cash, either in terms of expenses or in terms of revenues and gains, if everything was by cash, then you could pick the net profit and classify it as your net cash inflow from operating activities. But is it true that we can now pick that net profit before tax to represent the net cash inflow? The answer is no. Why? Because that profit, some of the items you could have debited in the P&L account, or some of the items you could have credited in the P&L account, were not involving cash. Were not involving cash. Okay? There could be things you debited in the P&L account as an expense where no cash was paid, or there could be something you credited in the P&L account as a revenue or as a gain where no cash was received. But according to the rules of accounting, you are not wrong. According to the rules of accounting, you are not wrong. Now listen. So we want to ask ourselves, what would have been the true profit? Listen, what would have been the true profit if everything in the P&L account was by cash? That's what we want to determine. If everything in the P&L account was by cash, what would have been the true net profit? That which would have been the true net profit now is the one we shall take to represent the net cash inflow. So to determine that profit, to determine that profit which would have been the true profit if everything was by cash, what do? Listen, you now take whatever the question has given you as the net profit before tax. You can even call it profit before tax. You take it as per the question. Don't forget, anytime the examiner used to give you a question on cash flow, he would give you the income statement for that year and two balance sheets. You remember? One for last year balance sheet, another balance sheet for this year. So you go to the income statement and pick whatever the question has given you as the profit before tax. Then, listen, then adjust it with those items which are in the income statement, yet no cash was involved. Adjust that profit with those items which are in the income statement, yet no cash was involved. So that you argue this way. If there is something I debited in the P&L account as an expense, yet no cash was involved, I would ask myself, what effect did it have on the profit? In other words, if it was not there, that item which is not a cash transaction, if it was not there, would my profit have been, let us assume our profit was 30 million. You ask yourself, if that item in the P&L account was not there, would the profit have been more than 30 million or would it have been less than 30 million? That's what we want to argue. So that if it's an expense that you debited in the P&L account, yet no cash was involved, then you will argue this way. From the cash point of view, not from the profit point, P&L point of view, from the cash point of view, if that item was debited in the P&L account, then it made your expenses more than it should be. It made your expenses more than it should be from the cash point of view. So to correct that profit, you will come and add back that item. If it is something that you credited in the P&L account, either as a gain or as a revenue, yet no cash was received, according to the rules of accounting, you are right. But now, as per the cash flows, it is not a cash item. So you ask yourself, if it was not there, would my profit have been more than 30 million or less than 30 million? Then you realize, by you crediting P&L account with that item therefore overcasted your profit. It overcasted your profit. So to correct that profit, you will be required to come and deduct. Okay? Good. That is how we want to identify those items. Listen, so we are now trying to find out what are those transactions that could have gone to the P&L account which no cash was involved at all. We normally refer to them as non-cash items. So you pick whatever profit before tax the question has given you, then adjust it with those non-cash items. Now, I would want you to give me some of the non-cash items that you know. Some of the non-cash items that you know are items that went to the P&L, yet no cash was involved. Give me a few examples of those items. Give me a few examples of those items. Of course, I've told you this is not the first time we are doing this topic, so I expect you to remember. Or, listen, if you are not remembering from the point of view of cash flow, you are now accountants. You obviously know from your accounting knowledge, you know some items that are either debited in the P&L account, yet no cash was involved, or items credited in the P&L account, yet no cash was involved. So I'm asking you to remember these items, either from the point of view of your remembrance of the topic of cash flow, or from the point of view of accounting as a student. What could this be? Items that were debited in the P&L account, yet no cash was involved. Somebody? Good. Somebody has given me one. Depreciation. Correct. So if we debited P&L account with the charge for the year for depreciation, which we normally do, when we normally debit P&L account with the charge for the year for depreciation, which we normally do, we are saying that depreciation did not affect cash flows. It's just a bookkeeping entry. So we normally come and say, okay, what effect did it do? Our expenses were overcasted. So if expenses were overcasted, automatically profit was undercasted. When expenses are overcasted, profit is undercasted. So you come and add back that depreciation charge. Whatever is the depreciation charge for the year, you add it. Good. Somebody has given me another one. That's correct. Gain or loss on disposal. Correct. Let me take it. Suppose you have a motor vehicle which had a book value of 10 million. You had a motor vehicle which had a book value of 10 million. You sold it for cash of 8 million. Obviously, as a business, you made a loss of 2 million. Okay? That loss of 2 million, you must have debited it in the P&L account as a loss on disposal. Did you repay that 2 million? The answer is no. But you took it to the P&L account as an expense. What we received is 8 million, but we took to the P&L account a loss of 2 million. That loss of 2 million is not a cash item. It is obviously a non-cash item. Okay? We are saying therefore, that is another item. So you ask yourself again, you recognized a loss of 2 million. What effect did it have on my profit? Did it make my profit more than it should be or less than it should be? Obviously, your expenses were more because you included it among the expenses. Your expenses were more than they should be from the cash point of view. Your expenses were more. When expenses are overcasted, obviously profit is undercasted. So with any loss on disposal, you will come and add back. Good. Now listen. What if the same machine which had a book value of 10 million, this time you sold it for cash of 18 million. You sold it for 18 million, which means you made a profit of 8 million. You made a profit now of 8 million. That profit of 8 million, you took it to the P&L account as a gain. That 8 million. But did you receive 8 million? No. What you received is 18 million. We are not discussing the 18. We are discussing the 8. 18, we shall discuss it later. But for now, that's 8 million. You took it to the P&L account as a gain. Then we are arguing. It is not a cash item. But you took it to the P&L account as a gain. What effect did it have on your profit as far as cash flows are concerned? Argue by saying, made your profit more than it should be from the cash point of view. So any profit on disposal, having made your profit more than it should be, that one we shall be deducting. Good. I'm still waiting for people to give me other non-cash items that you remember, from your concept or from your topic of cash flow or from your knowledge of accounting, any other non-cash items. Somebody to chat. There are too many. There are too many items. Yes. There are normally too many items. So I'm still waiting. There are still too many items, which I'm still waiting. Yes. Other non-cash items that normally go to the P&L account, yet no cash was involved. Remember, any other non-cash items. Remember, any other non-cash items which normally go to the P&L account according to the rules of accounting. But when it comes to cash flows, it's not a cash item. There are too many. There are too many items. Somebody remember? I am still waiting. The list is so long. The list is so long. These are not the only two. Yes. Good. Impairment. Thank you. When you impair your goodwill, for example, that impairment of goodwill, again, it's normally not a cash item. So any impairment loss of an asset, we normally again say you must have debited P&L account, yet no cash was involved. Good. And somebody has to add another one. Somebody has to add another one. We still have so many. We still have so many. Somebody has to add another one. You chat. Give me another one. Chat. I'm still waiting. Other than depreciation, other than the loss on disposal, gain on disposal, impairment, unrealized loss on forex. Okay, fine. So any unrealized loss. In other words, we can say, let me just put it this way. Let me just put it this way. Maybe something like provision for bad debts. Any provision for bad debts. Of course, provision for bad debts is a loss. So when you anticipate that some of your debtors are likely not to pay you, you normally make a provision. Okay? So any loss that you anticipate, that is what we are saying you also have to recognize. So any provision for bad debts, you anticipated that some of your debtors are likely not to pay you. The rules of accounting say, make a provision. Good. So you made a provision for bad debts, you debited P&L account. For the rules of accounting, that's okay. But when it comes to cash flow, it's a non-cash item. Good. Listen, even the bad debts themselves, when a customer is declared bankrupt and he has to be written off, you normally write off that bad data by crediting the data and debiting bad debts. That's the double entry. You credit the data and you debit bad debt to write him off. Then come the end of the year, the balance in the bad debt account goes to the P&L account as a loss. So whatever you debited in the P&L account as a bad debt, you did not pay. It's just a bookkeeping entry. Good. Somebody is adding us goodwill there. Goodwill goes with the impairment. Somebody is adding goodwill, Jane. That is true, but it's goodwill that goes with impairment. So it is the impairment. Goodwill is an asset on its own. But when you impair it, that's the impairment we have just identified. So Jane, goodwill being an asset, we are not bringing it in the P&L account. But when you impair goodwill, that's what we are saying. Next, we still have some more. 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 Any more? Okay. Now, before I push you to give me another one, let me add you some more. Another one could be in amortization. When you amortize your intangible assets, you normally charge that again. Amortization is the same as depreciation. It's only that we don't call it depreciation. When you are amortizing or when you're depreciating intangible assets, we classify it as amortization. Okay, good. Whatever it is. Rosemary is giving us dividend income. The answer is no. Dividend income is a cash item. When you are receiving dividends, it's a cash item. Okay, and we shall also talk about it in details. Good. But we are saying dividend income is a cash item. Me, I'm looking for what went to the P&L account, which no cash was involved. Okay, good. Okay, but for dividend income, we shall discuss that in details later. Okay, now listen. Now, let me for now, let me assume that you have identified the non-cash items. I am assuming you have taken your profit before tax, you have added depreciation, loss on disposal, gain on disposal, impairment, provision for bad debts, amortization. Let me assume for now that those are the only ones. Once you are through with that, you remember you had to get the totals. Okay? Let us assume you have identified everything. That total, if you remember, you had to call it cash flow before working capital changes. Cash flow before working capital changes. Once you identified the non-cash items, you had to call that total cash flow before working capital changes. Listen, then you had now to bring in the changes in the working capital. Of course, you know working capital is current assets, comprised of current assets and current liabilities. So go look for the changes. I have told you the examiner will give you balance sheet for last year and this year. So look for the changes in the working capital items. Let us start with the items on the current assets of your balance sheet. One of them being stocks. Maybe the stocks last year were 5 million. Maybe the stocks by the end of this year are 6 million. So there could be some increase. Stocks. When there is an increase in stock, what could have happened? It is obvious for stocks to go up, you must have purchased as a company. You must have purchased. That is an outflow. Okay? Then you go back to the same balance sheet, find out what is other current assets given. Maybe they are datas. From the balance sheet last year, datas were 2 million. Maybe by end of this year, datas are 1 million. So there could be what we call decrease in datas. For datas to go down, what would have happened? Datas to go down, it is obvious the customers must have paid us. In other words, we must have received from datas. For datas to go down, we must have received. That is obviously an inflow. Okay? Then you go back, go back to the balance sheet among the current assets. Normally after stocks, after datas, we normally come to cash. That's normally the next item. Listen, do I have to analyze cash by saying increase or decrease in cash? No. Listen, as much as it's true it's a working capital item, you don't analyze it here. Why? Because we have already agreed that the cash has its own specific place in the cash flow. Down there, I told you, you have to come and add opening cash and cash equivalent. You have to add opening cash and cash equivalent. So when we were adding that, then you don't have to analyze it again among the working capital changes. So cash, we normally don't analyze it together with the other items like stocks and datas. No, because it has its own specific place in the cash flow statement. Good. Now, so let me assume for now that we are through with the current assets. You go to the second component of working capital, that's current liabilities. Okay? Among the current liabilities, let us assume that the only one you are given by the question is creditors. Again, go to the balance sheet last year and you find your creditors were 2 million by end of last year. This year, the creditors are 500,000. So creditors have gone down. Oh, what do? What do you interpret when there is a decrease in creditors? Decrease in creditors. For creditors to have gone down, what could have happened? It is obvious for creditors to go down. That's a liability. We must have paid. For liabilities to go down, we must have paid. So that is an outflow. Obvious. Okay? Now listen. I have assumed that was the only current liability. That's all for the working capital changes. Then you get the totals again. I hope you still remember all this. Get the totals. Once you get the totals, listen, I hope you still remember, you had to come and minus what you called tax paid. Tax paid. Once you minus the tax paid, whatever you got as the net amount, that is the net amount. I was saying you push it to the extreme. That is the net you push now to the extreme to represent your net, either cash inflow or your net cash outflow if it's a negative. Okay. For now, again, let us assume it's a positive. You call it net cash inflow. You call it net cash inflow from operating activities. Net cash inflow from operating activities. Good. We go to the second category now. But before we go to the second category, of the cash flows, listen, I want to come back to you among the non-cash items. I want you to listen carefully now. Anytime you ever did a question on cash flow, among the non-cash items, there were two of those non-cash items, listen, which you ever got in any question. I'm saying, anytime you did a question on cash flow, among the non-cash items you ever got in any question, there were two which were always there. The others depended on the question. But there were two non-cash items which were always there in any question that you did. One of them is depreciation. That one you should never forget, and you should not lose the marks for it. And by the way, even the amount of the profit before tax, that is something one should not lose the marks for. Why? Because you just go and pick it from the income statement, pick it and bring it there. Why should you lose marks for it? Yeah? Then the other non-cash items, now I'm talking of non-cash items. I've said, in any question you ever did or you will ever do, two non-cash items, you will always find them. One is depreciation. Listen, the second one, you have not given it to me. Among the ones you have given me, you have not given me the second and always must find item in the cash flow questions. I don't know how you have forgotten that second item, yet in any question you ever did, it was always there. So I'm still asking you to try and remember other non-cash items. Now maybe you could pick another one and maybe it's the one I'm looking for. Because I've said, you have given me loss on disposal, that's correct. Profit on disposal, impairment, provision for bad debts, amortization. Somebody has given me unrealized loss on Forex, that's true. But those ones are not a must find in any question. It depends with the question. But there are two non-cash items you will never miss. One is depreciation. Two, you have not given me. Try and remember which is this second non-cash item which you will always find in any question. Somebody try and remember now. Who is this? Is it Phyllis? Why have you been so quiet for that long? I don't want you to comment, but you have been so quiet, yet you knew, Ama, you are doubting yourself. I don't know, because you have given me the right answer. You have given me the right answer, but okay. Sawa. Thank you. So let me discuss it. That's what we call interest. Some books will call it finance cost. Okay? But before I discuss it, how it is an uncashed item, let me give you an illustration. This one I want you to answer me now. When you are doing financial accounting, you did a topic of company accounts. And in the topic of company accounts, you used to be given a trial balance. Let us assume you are given a trial balance of this nature. Maybe you are given a 10% debenture. And in that trial balance, the amount of the debenture is 500,000. Then in the same trial balance, you are given something like interest on debentures, maybe an amount of 40,000. And the question could tell you, after this trial balance, I'm assuming together with other items, then you are told prepare an income statement and B, balance sheet. My question is this. When you are required to do P&L account for this company, when you were required to do P&L account for this company, how much? The question is, listen, how much? I just gave depreciation. Yeah, but you should have added the interest. That's true. You gave me depreciation. But when I was asking for some more, Phyllis, you should have added. Okay, thank you. Let's continue. Thank you that you have given it at last. But let's now discuss, because there's also a challenge. Listen, other than knowing that it should be there, interest, Phyllis, other than knowing that it should be there, another important thing is to know how much. That's what I'm trying to do now. Okay? That's what I'm trying to demonstrate now. Listen. So remind me, whenever you are given a trial balance of this nature, now from accounting point of view, you are given a trial balance. In that trial balance, there is a 10% debenture amounting to 500. In that trial balance, there is interest on debenture amounting to 40. Then the question tells you to prepare A, income statement, and B, balance sheet. My question to you is this. In the P&L account, how much would you charge as interest? How much would you charge, or were you charging as interest? Whenever you're given a trial balance of this nature, how much would you charge as interest in the P&L account? Somebody chat. Assuming you are given this as your trial balance, you are required to prepare an income statement. How much would you charge in the income statement as interest? Somebody to chat and tell me. Chat and tell me, when you are given a trial balance of this nature and you are required to prepare an income statement, how much were you charging as interest? Somebody has said 50. Yeah? Anne says 50. Somebody else? Somebody else? Somebody else? I'm not saying Anne is right. I'm not saying Anne is wrong. I just want to see an opinion. Do you agree with her? You say yes. You can chat, put your 50. Or if you are differing with the amount, you say, tell us yours. I want to see a second opinion. I want to see a second opinion. Yes. I want to see a second opinion. Yes. Somebody to suggest either you agree with the 50 or you are given this trial balance. Then you are being required, whether it's, of course, in company accounts, and of course, other topics also, which required you to prepare income statement. So when you're given a trial balance of this nature, it could be not interest on debenture. It could be interest on loan. It doesn't matter. My concern is interest. That interest, it does not matter whether it's interest on debenture or interest on loan, just interest. how much would you charge as interest? Somebody else? From this illustration. Again, Virginia says 50. Thank you. Sawa. Now listen. It's true, when you are required to do income statement, listen, when you are required to do income statement, you normally had to follow a concept you call accrual concept. I hope you still remember what that accrual concept states. The accrual concept states that when you are doing an income statement, that's the concept you follow. When you are preparing financial statements, we normally apply the concept of accrual concept. That concept states that you recognize costs when they are incurred. You recognize costs when they are incurred, but not when money is paid. You recognize costs when it is incurred, but not when money is paid. Meaning, it does not matter. When you are doing the P&L account for the company, it does not matter whether you have paid that expense or you have not paid it. You are supposed to recognize costs when it is incurred, but not when money is paid. For example, from this question, I can see the company had a 10% debenture. Every year, they are supposed to pay their debenture holders interest at 10%. So 10% of 500, that amounts to 50,000. Listen. So whether the company has paid it or not, that is the charge for the year. So when they are doing the income statement, they debited the P&L account by 50. Whether they had paid it or not. Why? Because they are supposed to follow the accrual concept. Recognize cost when it is incurred, but not when money is paid. Listen. But then when this company was doing their balance sheet, when this company is now doing their balance sheet, that is normally the time they normally have to bother themselves and ask themselves, listen, as a company, do we owe our debenture holders anything? From this trial balance, I'm supposed to pay them 50. But what have I paid them? I've only paid them 40. So there's a balance of 10, which I still owe to my debenture holders. And that 10 is what you take to the balance sheet now as a current liability. Among your current liabilities, there you normally have now what we are calling debenture interest owing of 10. Now I relate it to cash flow. Now listen, if you are given this company and you are told to do their cash flow statement, listen, the point is, you as an accountant of this company, you debited P&L account of that company with the interest charge of 50. With the interest charge of 50. But the question is, did you pay that 50? No. That 50 is just a bookkeeping entry. Just a bookkeeping entry. What you paid is 40. So 40 is what you paid. But what did you charge in the income statement? You charged 50. How did we get the 50? 10% of 500. What I'm trying to say now is that among other non-cash items that you will always get is that amount of the interest charge the year. It could be interest on loan or interest on debentures. Okay? Listen to this now. Some books don't call it interest. Some books call it finance cost. Okay? Now, so among the non-cash items, you have a non-cash item called finance cost or interest charge of 50. Listen, when you will be doing your cash flow statement, where will the 40 go? We paid 40. 40 now, listen, 40 will now be recorded among the financing activity down there. We have not been there yet, but I talked about the last category being financing activities. You paid 40 to these financiers whom we are calling debenture holders. So you borrowed by issuing debentures. So the cost of borrowing is the interest you paid. So whatever you paid as interest, that amount now, which is 40, is the one you take to the cash flow statement. Listen, is the one you take to the cash flow statement as a financing activity. Otherwise, the 50 you charge in the P&L account is a non-cash item. It's just a bookkeeping entry. So I take you back now. Among the non-cash items that you will always find in any question is this figure we are calling finance cost. Don't forget. Again, you debited P&L account and yet you never paid anything for it. The amount called 50. Okay? That's what you debited P&L account with. Yet you never paid anything for it. That is the one we are saying you take it as an non-cash item. The 50. The 40, I'll take it down there in the cash flow among the financing activities. Okay? Good. So I've told you, listen, two among the non-cash items you will never miss in any question is the finance cost and the depreciation. Now, for finance cost, it is something you just go pick from the income statement. Why should you lose the marks for it? Because you'll be given the P&L account for the company. So just go and pick the finance cost that they are charging in the P&L account. Okay? Depreciation, sometimes you are not given the charge for the year. Sometimes you have to calculate it. Sometimes you are given. So for depreciation, it's if you are given the charge for the year, pick it. If you are not given, calculate it. But it will always be there in any question. Good. So let me take it now that we are through with the first categories of the cash flows. That is cash flows from operating activities. Now we go to the second class of cash flows. Where we now go to the cash flows from investing activities. Okay? We now come to cash flows from investing activities. Cash flows from investing activities. Now, before we identify them, again, you need to know what are investing activities. What are investing activities? Listen, you remember, because I'm saying we are revising. Investing activities are those transactions and events that affect any fixed assets. A transaction that affects a fixed asset, that transaction is classified as an investing activity. Any transactions affecting a fixed asset is an investing activity. Okay? For example, as a company, you could have purchased your fixed assets. Maybe you bought a motor vehicle, or furniture, or building. That's a transaction that is classified as financing as an investing activity. Purchase of fixed assets. Obviously, that's an outflow. Okay? That's an outflow. Maybe this time you also sold motor vehicle. Come and see a sale of fixed assets. Sale of fixed assets. That's an inflow. Good. Now listen, we are saying investing activities are those transactions that affect any fixed asset. Listen to this now. Suppose you go to the balance sheet of the company, and among the balance sheet items, I've said you will be given two balance sheets. One for last year, let's say 2021. One for this year, 2022. Among the fixed assets you have land, whatever it is, motor vehicle, whatever it is, and so on. Now listen, within those fixed assets, maybe you also have investments. One figure last year, 5 million. Another one this year, 6 million. Listen, I have said, investing activities are those transactions that affect fixed assets. So we can now see among the fixed assets of this company, they have an investment. That automatically tells you these are long-term investment. These are long-term investment. That's why it's in the balance sheet as a fixed asset. Okay? Now, if the investment last year was 5 million and this year it's 6 million, what could have happened? It is obvious you must have purchased some investments. So we are saying another example of an investing activity is purchase of investments. Purchase of investments, that's an outflow. Now listen, this investment that you purchased, this investment would have given you as a company some dividend income. From your investments, this year you received your dividend income from your investment. Maybe you bought shares in Safaricom, you are keeping them for long term. By the end of the year, they are giving you dividend. Listen now. So you are receiving an income from your investment. Listen, that income you are receiving from your investment, we shall also be classifying it as an investing activity. Any investment income is an investing activity. I hope now Felix is okay. Was it Felix? There was somebody who mentioned investment income and I said no. No, it was Rosemary. Are you okay now? Where investment income should come in when it comes to cash flow? Rosemary, I'm waiting for your go ahead. I now hope you now know where the investment income should go. We have said when you buy an investment and you classified it as a fixed asset in your balance sheet, once you receive an income from that investment, then it relates to a fixed asset. So any investment income should be classified as an investing activity. That's why I'm saying whether Rosemary has now got the point of where we normally classify. When I was asking for non-cash items, she gave us investment income as one of them. Then I told her no, but I told her I will explain later where it should be. This is where it belongs. Any investment income, we should be classifying it as an investing activity. Any purchase of fixed asset investment or even sale of investment should be classifying it as an investing activity. Okay, good. So if Mary you're okay, you can give us a go ahead. Meanwhile, let's be going on. Listen, for now, let me assume those are the only investing activities. Okay, Rosemary has said okay. Now we can move on. So we get the net. Let me assume those are the only ones. Get the net, and whatever you get, you push it to the extreme. For now, let us assume you got a negative amount. Maybe the negatives were more than the positives, so you got a negative amount, and that negative is now what we can call net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Okay, good. That is all for the second category. Now we go to the third category now. Go to the third category, and that's what we call cash flows from financing activities. Cash flows from financing activities. What are these kind of cash flows? What is financing activity? Financing activities are those transactions that affect your finances. Financing activities are those transactions that affect finances. Okay? For example, you as a company, you could have borrowed, or you want to finance your company by issuing shares. One of the examples of financing activity is issue of shares, whatever it is. Another one could be issue of debentures. Maybe you issued some debentures, borrow finances. That could be another one. Maybe this year you repaid part of your loan, still part of financing. Loan last year was 5 million. This year the loan is 2 million. You must have repaid your loan. So if there was any loan repaid, that an financing activity, but a negative. Okay, listen. For now, let us assume that those are the only major, the only major financing activities from your balance sheet. Issue of shares, issue of debentures, and maybe loan repayment. Listen, but these are financials. And whenever you borrow from the financials, you as a company, you are required to pay them their return, the cost of borrowing. For example, When you borrow by issuing shares, you pay the shareholders dividend. When you borrow by issuing debentures, you pay debenture holders interest. When you borrow by through loans, you pay loan interest. So whatever you are paying to the financiers as their return, that is also classified as a financing activities. Among other financing activities we shall be having is what you call dividends paid. Dividends paid, whatever it is. Okay? The other one is what we are calling interest paid. Interest paid, whatever it is. Good. So let us assume now that from your question, those are the only financing activities. Again, get the net of all of them, push it to the extreme. Get the net of all of them, push it to the extreme. Let us assume it's a positive now. It's a positive. You now call it net cash inflow. Net cash inflow from financing activities. Net cash inflow from financing activities. Good. Then I told you, once you have identified the three categories of cash flows, get the totals of those three figures: the operating amount, investing amount, and the financing amount. Get the total of those three. Let us assume you have got it and you get a positive amount. I said that positive amount now becomes what we are calling increase in cash and cash equivalent. Increase in cash and cash equivalent. Okay? Then you come and add, I told you, come and add what we were calling opening cash and cash equivalent. Opening cash and cash equivalent, whatever it is. Once you add the opening cash and cash equivalent, get the net. That one I told you should be called closing cash and cash equivalent. Closing cash and cash equivalent. Good. Now you know how to prepare a cash flow of an individual company. Of an individual company. So what we shall do is now to incorporate the aspects that relate to group. Maybe you are a group company and therefore there are some other aspects you have which are not involved for individual companies. They are only involved in group. But before we go to those ones, maybe we can put down this format now. Let's put down this format of the cash flow so that now I develop the topic now. Let's copy this format now. Let's copy this format. Copy that. Copy that format. Then we develop the topic. So we are starting with the cash flows from operating activities. I said you start with the profit before tax, adjust it with the non-cash items, identified them like depreciation charge, finance cost, loss on disposal, gain on disposal you minus, because I said it made your profit more, minus. Then we said impairment. Then we talked about provision for bad debts. Then we talked about amortization. Bad debts and amortization. Copy up to there. Then I roll the page. Finish. So we have copied that, I hope so. That is the cash flow from operating. Hope you have copied up to there. Let me roll the page. So let me roll a few more items up that you can copy them again. Okay, you can add those ones. We were at the point of amortization. Now I've got the totals. I said once you get the amortization, or once you identify the non-cash items, get the total. And that's what we were calling cash flow before working capital changes. And I told you, you get the working capital items from this illustration. They are putting increase in stocks, that's a negative. Then you go to decrease in debtors, that's an inflow. Then you come to decrease in creditors, that's an outflow. Copy those three more. I roll the page. Okay, let me roll the page. After working capital items, I've rolled the page now. Minus the tax paid. After you minus the tax paid, you get the net. Push it to the extreme. That net, we have called it net cash inflow from operating activities. That was all for that category. Then I said you go to the second category, and that is cash flow from from investing activities. Cash flow from investing activities. Cash flow from investing activities. We have given a few examples, like purchase of fixed assets, sale of fixed assets. Then I've said purchase of investments. Okay. Let me roll again slightly. Okay. So after purchase of investments, we have added some more item there, investment income. Then I said once you get those ones, for example, assuming that's all, I told you to get the net of all the investing, push it to the extreme. We have done it, and we have got a negative. I'm assuming it was a negative. That's what we have pushed to the extreme, and we have called it net cash outflow. We have called it net cash outflow from investing activities. We have pushed it to the extreme, and we have assumed our negatives were more than the positive. Ours is a negative, called it net cash outflow. Then from there, we have to go to the last category now. Let me push it. And that is the category we are calling cash flow from financing activities. Cash flows from financing activities now. Among the examples we have given for financing, we have identified issue of shares, issue of debenture, loan repaid, dividends paid, and interest paid. Okay? Then I assumed those were the only ones. Then I got the net. I had to push it to the extreme. Let me roll the page. Okay. Once you got the interest paid, and you minus, you get the net, you push it to the extreme. We assumed ours was a positive. So we called it we called it net cash inflow from financing activities. Net cash inflow from financing activities. Net cash inflow from financing activities. Then I had to get the net of the three totals. Net of the three totals. I said if it's a positive, you call it increase in cash and cash equivalent. I said if it's a negative, you called it decrease in cash and cash equivalent. Ours was a positive, called it increase in cash and cash equivalent. Then you come and add opening cash and cash equivalent. Finally, get the closing cash and cash equivalent. Good. Finish. Okay, I want to believe you are through. Yes, done. Thank you. Okay, so let me develop the topic slightly now. May not have much to talk about now because of time, but let me remind you again. Listen. When you did this topic of cash flow, you remember there were two formats of preparing a cash flow statement. One method, you used to call it the direct method, and the second method is what you used to call it the indirect method. We have used one of the methods, and the method we have used is the indirect method. Now listen. The difference between the two methods, of course, in the two methods, you still have to categorize the cash flows into three. But the only difference between the presentation with the two methods is that the two methods only differ when you are presenting your cash flows from operating activities. When you are presenting your cash flows from operating activities. Listen. When it comes to investing and financing activities, the two methods are the same. The figures remain the same. The only difference between the two is how to present the cash flows from operating activities. But even though you are presenting them differently, the net amount you get, whichever method you are using, the net amount should be the same. Whether you are using the cash flow, the indirect or the direct, what you get as the net cash flow, net cash inflow from operating should always be the same. But for now, I've said we have used the method called the indirect method. So maybe what you could even do, go back to the format at the start and in brackets somewhere there, indicate indirect method. Just to remind you that we are using the indirect method. Just to remind you that this is the method we are calling the indirect method. Okay? Now, the question now is, how do you present your cash flows from operating activities using the direct method now? Using the direct method. Now, let me just remind you, listen, whenever the examiner or whenever a question requires you prepare cash flow statement using the direct method, listen, for direct method, you only needed three figures. 1, 2, 3. Once you identified those three figures, you had to get the net, then you had to come and say tax paid. You have to minus tax paid. Then whatever you get, that's what you are pushing to the extreme to be the net cash inflow, or if it's a negative, be the net cash outflow. So for this direct method, there are only three figures you need. Two of them you can see, I've put them in bracket, meaning they are negatives. One is a positive. So the question is this: which are these figures that you needed whenever you are preparing cash flows from operating activities using the direct method? Is there somebody who can remind me at least one? At least one of the three figures? Somebody who can remind me that when you are required to do cash flow statement using the direct method, there are three figures you needed to get the cash flow from operating activities. Two of them are in bracket. That means they are negatives. One is a positive. So is there somebody who can remember one of the three figures? Chat it down. Thank you. Thank you, Anne. Good. Thank you, Anne. Good. Another one? Maybe we can even make all of them. Somebody could remember another one. That's one of them. Cash paid to suppliers. That's one. That's correct. Somebody else who can remember at least another one? Or even Anne yourself? Maybe you could remember another one? Apart from the cash paid to suppliers, there another figure you could remember? Working capital changes, no. Working capital changes are only found in the indirect. Working capital changes are only found in the indirect method. Okay? Okay, so let me mention them. Now listen. Oh, somebody's giving us another one. They are coming. They are coming. Virginia, thank you. Virginia, thank you. Cash received from customers. Good. Seems I'll not have any problem when I'm doing a question now. So that's correct. Not sure, but this is cash received from debtors. And again, it's the same. Good. Cash received from who? From who? Rosemary, cash received from who? We need to identify that. It is cash received from customers. Okay? Let me pick it, the three now. Good. Thank you. Now listen. So the first amount is what we normally call cash received from customers. I'm not calling it cash received from debtors. We are not calling it cash received from debtors. We are calling it cash received from customers. Meaning, from all your customers, those customers you sold goods to by credit, how much did they pay you this year? From those customers you sold goods on cash basis, how much did you receive this year? So we are looking for cash received from all our customers. Okay. Next, you also need a figure called cash paid to suppliers. Cash paid to suppliers. Again, these suppliers, I am not saying cash paid to creditors. We are saying cash paid to suppliers. Meaning, these are all your suppliers. People who supplied goods to you, maybe on credit. How much did you end up paying them this year? Those customers, no, those suppliers who supplied goods to you on cash basis, how much did you pay them? All of them, what is it that we paid all our suppliers? That's why we are calling it cash paid to suppliers. Okay. Finally, you need another figure we call cash paid for services. Cash paid for services rendered. Cash paid for services rendered. Cash paid for services. Now, people have given you service as a company. What is it that you paid for them for those services? Employees gave you a service, you paid them salaries. Kenya Power gave you service for lighting, paid them for electricity. Yeah? So in other words, we are saying, for all your expenses, For all your expenses, whether electricity, insurance, telephone, postage, all of them, you received some service. What is it that you paid for those service? What is it that you paid for those service? That is the amount we are referring to as cash paid for services rendered. Okay? So those are the three figures that you normally need whenever you are required to do a cash flow statement using the direct method. You need the amount called cash received from customers. You need the amount called cash paid suppliers. You need the amount called cash paid for services rendered. Now, the only issue is the examiner will never give you any one of these three amounts. Normally, it is your responsibility to calculate them. Normally, it's your responsibility to calculate them. It is not like the other indirect method where you could pick in some figures and get the answers. Like, for example, the other method, you could pick the profit before tax. That one you don't need to calculate it. Just go and pick it. Depreciation, I said some questions give it to you. Pick it. Finance cost, I told you. Pick it. And other non-cash items like amortization, sometimes a question could tell you during the year the company amortized their goodwill by this much. You just know that's a non-cash item. So for the other method, it is easier to get some of the figures among the operating because they are either given or you know them. But for this method, it is important to know how to calculate each of these. Okay? We have no time to talk about how to compute these three figures, but next time we shall discuss how to calculate these three figures because they will never be given. Maybe for today we can stop there, pick it up from there next time. Just as a reminder, told you, if you are new, you have not subscribed, please subscribe. Okay? Just click that subscription button, subscribe to our YouTube channel. Also told you, those who are friends and they are doing this course, tell them we have financial reporting, advanced financial reporting, online classes. We have financial reporting. We have financial accounting. We have discussed all this. Then I've told you, if they are interested in any one of them, let them call me on 0722 65 8875 0722 65 8875. I've also told you, if they can't attend a live class, then they can still buy what we are calling pre-recorded videos, whole syllabus, that they watch them at their own free time, at their own pace. Okay? Otherwise, see you next time. Bye for now. Bye for now. If you have not subscribed, you are here and you have not subscribed, click that subscription button. Okay? Bye for now. See you next time. Bye for now. I hope you have enjoyed the subject or the topic. If you have enjoyed it, you can even click the like button. You can even like the button or click that like button if you have enjoyed the class for today. Thanks. Bye. If you have enjoyed the class, click the like button. Click that like button so that you have at least liked the class. Good. Bye for now. Click that like button. See you next time. So please subscribe if you have not subscribed. For everybody, click the like button if you have understood for today's class, which I hope you have understood. Okay, bye for now. Bye for now. See you.